In the last counseling session, we were discussing investment theories, and in that, we were discussing efficient market hypothesis. Continuing that, forms of market efficiency. Egan Pharma gave three flavors to market efficiency, and subsequently, all empirical testing has proceeded on these lines. These three forms have been discussed in detail as follows. Weak form of efficiency. The weak form means that the current prices of a stock fully reflect all the information that is contained in the historical sequence of prices. Hence, abnormal profits cannot be earned by studying the past behavior of share prices. In other words, weak form of efficiency implies that you cannot make excess profits by trading on past trends. You may be surprised to note that a lot of people do exactly just that. They are called technical analysts or chartists. By implication, technical analysis that relies on charts of prices, moving averages, and momentum and volume of trading is not a meaningful analysis for making abnormal trading profits. If the markets are efficient in weak form, what would you do if your securities that they are selling are worth less than the selling price? What would you do if you notice that every time the market went down by 1%, the next day on an average it went down again by half percent? If your answer is that you'd buy on an up day and sell on a down day, you have the makings of an active technical trader and you are using a trading rule. Semi-strong form of efficiency. How about all public information? That is all information available in annual reports, news clippings, gossip columns, and so on. If the market price impounds all of this information, the market is then called semi-strong form efficient. Most people believe that the US equity markets by and large reflect public available information. But one has to consider certain things. Whether the information placed on the internet is public, are government files available under the Freedom of Information Act public? There must be subtle shades of semi-strong market efficiency, but they are not typically differentiated. Each new piece of information an analyst gathers should be carefully considered with regard to whether it is already impounded in the stock price. The easier it was to get, the more likely it is to have already been traded upon. A strong form of efficiency. This represents the extreme case of market efficiency. What kind of information is impounded in the stock price? It turns out that there are lots of different levels of market efficiency, depending upon the source or the information being impounded. The best way to illustrate this is through example. Suppose you had a hyper-efficient market that impounded all private information. This means that even a personal note passed between the CEO and the CFO regarding a major financial decision would suddenly impact the stock price. If so, this is called a strong form efficiency. Few people believe that the market is strong form efficient, but it is nice to have this benchmark. Empirical test of EMH. What is the degree of efficiency witnessed in the stock market? Is it efficient of the weak form or semi-strong form or a strong form? In order to be able to answer these questions, certain empirical tests have been devised. Test of weak form efficiency. Two groups of tests have been formulated by researchers to test the weak form of EMH. One approach looks for statistically significant patterns in security price changes. Another approach searches for profitable short term trading rules, social independence, filter rules, run test, and distribution pattern test for weak form are described below. First one is statistical test of independence. EMH contends that security returns over time should be independent of one another because new information comes to market in a random, independent fashion, and security prices adjust rapidly to this new information. Does return of day T correlate with day T1 and so on Tn? Three major statistical tests have been used to verify this independence. One is the autocorrelation test, the other is the run test, and third is the distribution pattern. Second one, test of trading rules. The statistical test of independence were too rigid to identify the intricate price patterns examined by technical analysis. Technical analysis do not accept a set number of positive or negative price changes as a signal of a move to a new equilibrium in the market. They typically look for a general consistency in the price and volume trends over time. Such a trend might include both positive and negative changes. For this reason, technical analysis felt that their trading rules were too sophisticated and complicated to be stimulated by rigid statistical tests. Advocates of EMH hypothesized that investors could not derive profit above a buy and hold policy or abnormal profits using any trading rule that depends solely on any past market information about factors such as price, volume, outbound shares, or specialist activity. Test of semi-strong form. Semi-strong form contends that all public information is fully reflected in security prices. Public information includes company financial statements, earnings and dividends, bonus announcements, and macroeconomic data. The most obvious indication that the market is not always and everywhere semi-strong for efficient is that money managers frequently use public information to take position in stocks. While there is no evidence that they beat the market on a risk adjusted basis, it is hard to believe that an entire industry of information production and analysis is for naught. It seems likely that there is value to publicly available information. However, there are probably degrees to which information really is public knowledge. What is surprising is that recent studies have shown some evidence that excess returns can be made by trading upon very public information. These tests usually make the form of backtesting trading strategies. That is, you play a what if game with past stock prices and pretend you follow some rule using information available only at the time of the pretend trade. One common rule that seems to perform well historically is to buy stocks when the dividend yield is high. This apparently has made money in the past, even though the information about which of the stocks have high yields and which of them have low yields is widely available. Another rule that generates positive excess returns in backtests is to buy stocks when the earnings announcement is higher than expected. This seems simple, since current announcements and even forecasts are widely available as well. Does this mean that it is easy to become rich in stock market? Hardly. The profitability of these simple trading rules depends upon the liquidity of the stocks involved and trading costs. Sometimes the cost outweigh the benefits. While many investment manager explains that they pursue a strategy of buying value stock, such as low public interest entity for Few of these managers have consistently superior track records. Test of strong form. Strong form argues that all information is fully reflected in security prices. The top management has access to corporate and financing strategies. In the same way, specialists have access to the book limit orders for any share. Knowledge of the price and quantities of the limit order represent private information. Professional portfolio managers who have large research database and also access to top management may also have access to private information on a new company that has not yet been disclosed to the public. To disprove strong for EMH, one has to find an insider who has profited from inside information. The strong form of EMH is of two types. Super strong form, which includes insiders and specialists who possess monopolistic information. And second one, near strong form, which includes private estimates developed by who possess information, financial analysts, portfolio managers, etc. The Insiders Trading Regulation 1992 Act, last amended November 24, 22, the Securities and Exchange Board of India defined an insider as a person who is or was connected with the company or is deemed to have been connected with the company and who is reasonably expected to have access by virtue of such connection to unpublished price sensitive information in respect of securities of the company or who has received or has had access to such unpublished price sensitive information. Hence, an insider could be the company promoter, director, executive, auditor, a lawyer, a stockbroker, a fund manager, or even a newspaper correspondent who may be privy to a certain critical development in the company which could affect the company's share prices before the general public come to know of the development. The regulation has also given an illustrative list of information that may be construed upon as price sensitive information. It includes financial results, both half yearly and annual, declaration of dividend, both half yearly and annual, issue of shares by way of public, rights or bonus, any major expansion or execution of new project, amalgamation, mergers, takeovers, taxation charges, extraordinary events like strikes, etc. Further, the regulation says that a person guilty of insider trading based on reports submitted by the inspection of SEBI is liable to be punished with a civic penalty not exceeding 3 times of the profit gained or loss avoided as a result of dealing, subject to a specific minimum or punishable with rigorous imprisonment. More information on the regulation could be obtained from the SEBI website www.sebi.government.in. With the implementation of the regulation to curb insider trading, it is hoped that the stock market would become more efficient and devoid of malpractices. A simple test for a strong form of efficiency is based upon price changes close to an event acts of nature and may move prices. But if private information release does not, then we know that the information is already in the stock price. For example, consider a merger between two firms. Normally, a merger or an acquisition is known about by an inner circle of lawyers, investment bankers, and the firm managers before the public release of the information. When these insiders violate the law by trading on this private information, they may make money. They also make it to the SEBI's wall of shame. Unfortunately, Stock prices typically move up before a merger, indicating that someone is acting dishonestly. The early move indicates that the market has a tendency towards a strong form of efficiency. That is, even private information is incorporated into prices. However, the public announcement of a merger takeover is typically met with a large price response, suggesting that the market, if not strong form efficient, leakage, even if illegal, does occur, but it is not fully impounded in stock price. Anomalies of EMH. The researchers have documented some technical anomalies that may offer some hope for technicians, although transaction costs may reduce or eliminate the advantage. Technical anomalies. A question that has been subject to extensive research and debate is whether past prices and charts can be used to predict future prices. Technical analysis is a general term for a number of investing techniques that attempt to forecast securities prices by studying past prices and related statistics. Common techniques include strategies based on relative strength, moving averages, as well as support and resistance. The majority of researchers that have tested technical trading systems and the weak form efficient market hypothesis have found that prices adjust rapidly to stock market information and that technical analysis techniques are not likely to provide any advantage to investors who use them. However, others argue that there is validity to some technical strategies. Number two, stock market anomalies. The stock market related anomalies include number one, fundamental anomalies. While investing is probably the most publicized anomaly of the fundamental anomalies and is frequently touted as the best strategy for investing, there is a large body of evidence documenting the fact that historically investors mistakenly overestimate the prospect of growth companies and underestimate value companies. Number two, calendar anomalies. These include anomalies like the January effect, turn of month effect, Monday effect, year ending effects, and so on. A lots of effects are there. Number three, other anomalies. The size effect. Some studies have shown that small firms means either to the related to the capitalization or to the assets, tend to outperform. The small stock effect was first documented by Rolf Bench. He divided the stocks on the New York Stock Exchange into quintiles based on market capitalization. The returns from 1926 to 1980 for the smallest quintile outperformed the other quintiles and other indexes. Others have argued that it is not size that matters, it is the attention sorry, and the number of analyses that follow the stock. IPOs, seasoned equity offerings, and stock buybacks. Numerous studies have concluded that initial public offering, IPOs, in aggregate underperform the market, and there is also evidence that secondary offerings also underperform. Several recent studies have also documented arguably related market inefficiencies. Insider transactions. There have been many studies that have documented a relationship between transactions by executives and directors in their firm's stock and the stock's performance. Insider buying by more than one insider is considered by many to be a signal that the insiders believe the stock is significantly undervalued and their belief that the stock will outperform accordingly in the future. However, many researchers question whether the gains are significant and whether they will occur in the future. The S&P game. The S&P game involves buying stocks that will be added to the S&P 500 index after the announcement but before the stock is added several days later. The fact that stocks rise immediately after being added to S&P 500 was originally documented by Andre Selfier as well as Lawrence Harris and Etienne Gouret in 1986. Opportunities may also exist with other index. Implications of EMH. There could be two important implications of EMH for portfolio selection. These are: number one, even simple random selection leads to portfolio which approximates the market very closely when 15 to 20 stocks are held. Index funds are an outgrowth of the increasing awareness and acknowledgement of market efficiency. Nobel laureate William Sharpe makes a simple yet powerful case against active management in his article, The Arithmetic of Active Management. If active and passive management styles are defined in sensible ways, it must be the case that number one, we forecast the return on the average actively managed dollar with equal the return on the average passively managed dollar. And number two, after cost, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. These assertions will hold for any time period. Now we come to the second theory, random walk theory. In the last counseling session, I have told you that there are numbers of theories, but we are concentrating only on two theories: efficient market hypothesis and random walk theory. Random walk theory. According to the random walk theory, asset price changes are unpredictable. These indicates that because stock values fluctuate erratically, it is impossible to reliably anticipate future prices using data from the past. The stock market is said to be efficient and reflect all available information. According to the random walk theory, the notion that traders can time heap market or use technical analysis spot and capitalize on patterns or trends in stock prices is challenged by a random walk. Some traders and analysts who think that stock values may be forecasted using different techniques like technical analysis have criticized random walk. Features of random walk theory. According to the random walk theory, number one, stock prices are arbitrary and as a result, stock price or a market's historical movement or trend cannot be used to forecast its future movement. Number two, markets cannot be outperformed without additional risks. Number three, fundamental analysis is deemed unreliable because of the frequently subpar information gathered and susceptibility to misunderstanding. Number four, investment advisors don't significantly improve an investor's portfolio. Now, the second part of today's counseling, economy analysis. There is no point in investing in stocks or any other form of risky investment when the future performance of the economy is not expected to be good. For instance, stock market all over the world suffered major loss during COVID pandemic and it slowed down the economic growth. Economy analysis assumes importance for allocation of capital between equity investment and government securities. Many of us would like to invest in government security or a scheme of government which are not exposed to price variation risk during the period of economic downtrend. Fundamental analysis. Investment decision making being continuous in nature should be attempted systematically. Broadly, two approaches are suggested. These are number one, fundamental analysis, and number two, technical analysis. In the first approach, the investor attempts to look at fundamental factors that affect risk return characteristics of the security. In the second approach, the investor tries to identify the price trends which reflect these characteristics. The technical analysis concentrates on demand and supply of security and prevalent trend in share price measured by various market indices in the stock market. Economy and industry analysis are part of fundamental analysis. In the fundamental approach, various fundamental or basic factors that affect the risk return of the securities are examined. Effort here is to identify those securities which are perceived to be mispriced in the stock market. The assumption in this case is that the market price of the security and the price as justified by its fundamental factors called intrinsic value are different and the marketplace provides an opportunity for a discerning investor to detect such discrepancy. The moment such a discrepancy is identified and the decision to invest or disinvest is taken, the decision rule under this approach is as follows. If the price of a security at the marketplace is higher than the one which is justified by the securities fundamentals, sell that security. This is because it is expected that the market will sooner or later realize its mistake and reduce its price. Therefore, before the market realizes its mistake and price that security properly, a deal to sell this security should be struck in order to recap the profits. But if the price of that security is lower than what it should be based on its fundamentals, it should be brought before the market corrects its mistake by increasing the price of security in question. The price prevailing in the market is called market price, and the one justified by its fundamental is called intrinsic value. Fundamental analyst and efficiency market. Fundamental analysis is not free from criticism. It is pertinent to mention that doubts are exposed about the utility of this approach in the context of efficient stock market, which already incorporates the information about the economy, industry, and company in the share price. It is claimed that stock market incorporates such information in the share price rather instantaneously. The result of this assumption is that price prevailing at the marketplace can be taken to represent the price of the share justified by its fundamental, that is, intrinsic value. The equality of MP and IB makes the fundamental analysis or any other analysis useless or redundant. The above given view about share market efficiency implies that no one would be able to make abnormal gains given such a setup. Some research studies in the literature also support the above view. Practitioners, however, do not agree to such conclusions of empirical nature. Economy Industry Company EIC framework. The analysis of economy, industry, and company fundamentals are the main ingredients of fundamental approach. The analysis should take into account all the three constituents which form different but crucial steps in making investment decisions. These can be looked at as different stages in the investment decision making process and are depicted graphically with the three consequent concentric circles. The process of investment analysis starts with an evaluation of economic outlook. After getting some confidence on economic outlook, the analysis is moved to industry specific to identify industries which are worth for further analysis to pick up goods stock. The last stage is identifying specific stocks from selected industry. Operationally, to base the investment decision on various fundamentals, all the three stages must be taken into account. Economy analysis. All firms are parts of overall system known as the general economy, which witnesses ups and downs. It is logical to begin the valuation of process with projections of the macroeconomy. What you should grasp is that vast number of influences that affect the general economy. To give only a few examples, fiscal policy affects spending both directly and through its multiplied effects. For example, tax cuts can encourage spending, whereas additional shares. Fundamental industry analysis. All industries are not influenced equally by changes in the economy, nor they are affected by business cycles at just one single point, and the resolution of Cold War profits of defense related industries would win. The upturn in construction industry generally lags behind the economy. Similarly, a boom or expansion of the economy is not likely to benefit industries subject to foreign competition or product obsolescence. The equipment manufacturing industry will perform well towards the end of economic cycle because the buyer firms typically increase capital expenditure when they are operating at full capacity. On the other hand, cyclical industries such as steel and auto typically do much better than aggregate economy during expansion but suffer more during contraction. In contrast, non-cyclical industries like food processing or drugs would show neither substantial increase nor substantial decline during economic expansion or contraction. Company analysis. After determining that an industry's outlook is good, an investor can analyze and compare individual firms' performance within the entire industry. This involves examining the historical performance of the company, thus firms standing in the industry and future prospects. The last one is critical for estimation of cash flows and hence value. It should be noted that a good stock or bond for investment need not come from the best firm or market leader in the industry because the stock or bond of such firms may be fully valued or overvalued and hence there is no scope for earning additional return. Thus, investors always look for firms which are undervalued for investments than looking for firms which are best in respective industry. At this stage, you may ask a question. Why should the company label be the last stage in the valuation sequence? The valuation sequence can be defended and your question aptly answered if it could be shown that earnings, rates of return, prices, and risk labels of a company bear relationship with the economy or with the market, which is used as a substitute factor for the general economy. Measures of economic activity. The critical issue before investors is to assess the future of economic activity so that she or he can take an investment decision. It is possible by forecasting a few widely used economic measures. A discussion on such economic measures will be useful before discussing the forecasting techniques. Gross domestic product, GDP. Economic activity is measured by aggregate indicators such as the level of production and national output. The most widely and commonly quoted measure is gross domestic product or GDP, which is the total value of all final goods and services newly produced within the country's boundary with domestic factors of production. Cars made within the country are included in the GDP. Gross national product, GNP. A similar measure is gross national product, which measures the total value of all final goods and services newly produced by an economy and includes income generated abroad. Measures of consumer confidence. Consumer confidence index is one of the strong short-term economic indicators used by the investors to assess whether there is any change of direction in the economy. Consumer confidence affects spending, which has an impact on corporate profit and levels of employment. A positive change in the consumer confidence index or consumer sentiment index indicates a strong impact on the profitability of firms in general and in particular for firms dealing with consumer items. Inflation or consumer price index. In addition to aggregate measures of economic activity and leading indicators, measures of inflation can have an important impact on investors' behavior. Inflation in general denotes a general change in the price levels and measured in terms of index. Two commonly used indexes are consumer price index, CPI, and the wholesale price index, WPI. When the economy is spending fast, it is natural that money supply also increases along with disposable personal income of individuals and thus cause an increase in price. Sorry. Under this condition, stock market is favorably affected on account of increase in profitability of firms. Nevertheless, inflation affects interest rates and hence adversely affects the stock prices. An increase in rate of inflation will cause an increase in rate of interest of all kinds of securities. An increase in interest rate affects the value of stock as well as other securities in two ways. One, it affects adversely the profitability of firms because of higher outflows on interest costs. Two, it also increases the expected rate of return of investors and directly affects the discount rate. An increase in discount rate has an adverse impact on value of securities of different types. Such an adverse impact may ultimately lead to a recession and hence governments and central banks are concerned with inflation. A typical relation from the central banks, in our case Reserve Bank of India, is controlling money supply through appropriate monetary policies. A reduction in money supply through increase in CRR or SLR means cash reserve ratio or statutory liquidity ratio or increasing bank rate will reduce the heat of the economy and thus cool down the prices. After reaching necessary correction, the central bank of the country relaxes the knob so that the economic activity continues without any break. Interest rates. The level of interest rates is perhaps the most important macroeconomic factor to consider in one's investment analysis. Forecast of interest rates directly affect the forecast of returns in the fixed income market. Suppose you expect the interest rates to decline in the near future. Under this situation, you will shy away from investing in long-term debt instruments. Thus, a superior technique to forecast rates would be of immense value to an investor attempting to determine the best assets allocation for her or his portfolio. The following factors would help investors in forecasting the future direction of the interest rates. Number one, the supply of funds from savers, primarily households. Number two, the demand for funds from businesses to be used to finance physical investment in plant, equipment, and inventories. Number three, the monetary policy of the Reserve Bank of India. And number four, the expected rate of inflation. Government policy. The government has two broad classes of macroeconomic tools, those that affect the demand for goods and services, and those that affect their supply. For most of post-war history, demand side policy has been of primary interest. The focus has been on government spending, tax levels, and monetary policy. Fiscal policy. Fiscal policy refers to the government's spending and tax action and is part of demand side management. It is the most direct way to influence the economy. For instance, when the government increases spending, it creates more demand in the economy, and similarly, when the government reduces spending, it causes slowdown in the economy. Monetary policy. Monetary policy in the form of changing CRR and SLR is also demand side management of the economy. The central bank changes the money supply, rather adjusts the growth rate of money supply through variety of policies and thus influence the economy. One of the reasons for inflation being under control during the last 2 years is slowdown in the growth of money supply. If it increases the money supply, it will fuel the growth in the short run but causes inflation and higher interest rate in the long run. Similarly, the central bank by reducing the money supply can slow down the growth and prevent the economy to create overcapacity in several industries. However, monetary policy affects the economy in more roundabout way than fiscal policy. Now, economic forecasting. In order to perform economy analysis, it is essential to forecast economic performance with the help of some of the economic factors discussed in the previous section. Depending upon the duration, forecasting can be made for short term, intermediate, and long term. Short term refers to a period up to 3 years. Sometimes it can also refer to much shorter period, such as quarter or a few quarters. Intermediate period refers to a period of 3 to 5 years. Long-term forecasting refers to forecasting made for more than 5 years. This may mean a period of 10 years or more. We will discuss some short-term forecasting techniques. Number one, anticipatory surveys. This is very simple method through which investors can form their opinion with respect to the future state of the economy. As is generally understood, this is the survey of expert opinions of those who are prominent in the government, business, trade, and industry. Generally, it incorporates expert opinion with regard to construction activities, plant and machinery expenditure, level of inventory, etc., which have important bearing on the economic activities. Anticipatory surveys can also incorporate the opinion or future plan of consumer with regard to their spending. So long as people plan and budget their expenditure and implement their plans accordingly, such surveys should provide valuable input as a starting point. Despite the valuation inputs provided by this method, care must be exercised in using the information generated through this method. Precautions are needed because number one, survey results cannot be regarded as forecast per se. A consensus of opinion may be used by the investor in forming his own forecast. There is no guarantee that the intentions of surveys would certainly materialize. To this extent, the investors cannot rely solely on these. Number two, barometric or indicator approach. In this approach, various types of indicators are studied to find out how the economy is likely to perform in the future. For meaningful interpretations, these indicators are classified into leading, roughly coincidental, and lagging indicators. Number one, leading indicators. As the same name suggests, these are indicators that lead the economic activity in terms of their outcome. That is, these are those time series data of the variables that reach their high points as well as their low points in advance of the economic activity. Second one, lagging indicators. These are time series data of variables that lag behind in their consequences vis-a-vis the economy. That is, these reach their turning points after economy has already reached its own. And last one, roughly coincidental indicators. These are the indicators that reach their peaks and the troughs at approximately the same time as the economy. Number three, economic model building approach. This is another approach in determining the precise relationship between the dependent and the independent variables. In fact, econometrics is a discipline wherein application of mathematics and statistical techniques is made to economic theory. It presupposes the precise and clear relationship between the department and independent variables. One of such well-defined relationship with its attendant assumptions rests with analysis. Thus, by using econometrics, the analysis is able to forecast a variable more precisely than by any other approach. But forecast thus derived would be as good as the data inputs used and assumption made. Opportunistic model building or GNP model building or section analysis is frequently used in practice and is most electric method. It borrows from the methods discussed earlier. It uses national accounting framework in order to achieve short-term forecast. Various steps while using this approach are: number one, hypothesize the total demand in the economy as measured by its total income based on likely scenarios in the hypothesize the total demand in the economy as measured by its total income based on likely scenarios in the country like war, peace, political instability, economic changes they will, and rate of inflation, etc. Number two, forecast the GNP figure by estimating the levels of its various components like consumption expenditure, gross private domestic investment, government purchase of goods and services, net exports. Next, after forecasting the individual components of GNP, the analysis adds them up and gets a figure of forecasted GNP. Forecast of GNP test, the over forecast for internal consistency is done to ensure that both the total forecast and sub-components forecast of make sense and fit together in a reasonable manner. Thus, opportunistic model building involves all the details described above with a vast amount of judgment and inequity. Now, next part of the counseling, industry analysis. An industry is a homogeneous group of companies. That is, companies with the similar characteristic can be grouped into one industrial group. There are many other bases on which grouping of companies can be done. For example, traditional classification is generally done product-wise, like pharmaceutical, cotton, textile, synthetic fiber industry, etc. Such a classification, though useful, does not help much in investment decision making. Some of the more useful bases for classifying industries from the investment decision point of view are as follows. Number one, growth industry. This is the industry which is expected to grow persistently and its growth is likely to exceed the average growth of the economy. Number two, cyclical industry. In this category of the industry, the firms included are those which move closely with the rate of industrial growth of the economy and fluctuate cyclically as the economy fluctuates. Number three, defensive industry. It is a grouping that includes firms which move steadily with the economy and decline less than the average decline of the economy in a cyclical downturn. And last one, declining industry. This is that category of firms which either generally decline absolutely or grow less than the average growth of the economy. Now, structural analysis. Structural analysis is a key component of security analysis. It involves examining the underlying financial and operational structure of a company or security to determine its investment potential. This analysis looks at a company's financial statements, management team, industry position, and other key factors to evaluate its strengths and weaknesses. Some of the key components of structural analysis in security analysis include: number one, financial statement analysis. This involves analyzing a company's income statement, balance sheet, and cash flow statement to determine its financial health and performance. This analysis can help investors identify trends in revenue, profit margins, debt levels, and other key financial metrics. For example, an investor may analyze a company's revenue growth rate, profit margins, returns on equity, debt levels, and liquidity ratios to assess its financial health and performance. Number two, management analysis. This involves evaluating the company's management team, including their experience, track record, and strategic vision. This analysis can help investors determine the quality of the management team and their ability to execute on the company's business plan. For example, an investor may examine the CEO's vision and strategy, the experience of the board of directors, and the overall corporate governance structure to assess the quality of the management team. Number three, industry analysis. This involves assessing the competitive landscape and growth prospect of the industry in which the company operates. This analysis can help investors identify potential risks and opportunities associated with investing in the company's security. For example, an investor may review industry trends, market share, competition, and regulatory environment to assess the growth potential and risk associated with investing in the industry. Number four, company valuation. This involves determining the value of a company's securities based on its financial performance and growth prospects. This analysis can help investors determine whether a security is overvalued or undervalued relative to its intrinsic value. For example, an investor may use a discounted cash flow analysis to estimate the present value of company's future cash flows and determine whether the company's securities are undervalued or overvalued. Process of structural analysis. The process of structural analysis in security analysis typically involves the following steps. Number one, define the objective. The first step in the process is to define the objective of the analysis. The objective should be clearly defined and aligned with the investor's investment strategy and goals. Number two, collect data. The next step is to gather data on the company and the industry in which it operates. This data can be sourced from financial reports, company filings, industry reports, news articles, and other sources. Number three, conduct financial statement analysis. The analysis of financial statements involves reviewing the income statement, balance sheet, and cash flow statement to assess the company's financial performance and financial health. This includes examining key financial ratios such as profitability, liquidity, and solvency ratio. That's all. Namaskar.